Proposed wealth management living benefits this afternoon in beautiful sunny August afternoon. In this episode, we'll be talking about what should be one of the most relatable and likely the most common of the insurance coverages, which addresses the risk of a physical setback that pauses one's ability to work. This is a topic that is often misunderstood, how important it is to those with a family, preserving wealth, and having options to find the proper care in order to return to normal living. We hope through this session to provide our listeners some insight and also for reflecting on what living benefits is in place to protect, preserve, and in time return an individual to their job. With me is my colleague and Raymond James Zone personal insurance planning specialist, Greg Jizmejian. Greg has been with Raymond James since 2019. Greg has been helping families protect the people and values they cherish for almost 3 decades. And after 17 years as a vice president of a state insurance advisor at a bank-owned investment firm, he joined Raymond James as the insurance planning specialist for the Greater Toronto Area. Greg is a certified financial planner. He holds the Chartered Life Underwriter, the Chartered Financial Consultant, and most recently he completed the Elder Planning Counselor Program. Greg has also achieved the Trust and Estate Practitioners designation, known as the TEP. However, his greatest teachers have been his clients with their life experiences. That's why he's keenly interested in hearing your story. With that, I'd like to get us started. Thank you, Greg, for joining us.
Thank you, Jim, for having me on.
Greg, let me start with a broad question for you. What you have found is a good way to communicate living benefits to the everyday person.
Perfect. Yeah, let's define living benefits perhaps first, and then I'll get to that analogy you're referring to. So living benefits really the category of insurance that protects the individual themselves, the insured, not the beneficiaries. So they call it a selfish product, if you will. It's to protect you in the event that you're unable to work or too sick to deal with certain circumstances. So it's a combination of various products. Usually, income replacement and critical illness are the two sort of camps of things that we cover. But the analogy I love to use to describe that is a car. There are two things that keep you safe in a car typically, and most of us are very familiar with it. So I'll draw on that. So your seatbelt is hopefully usually on at all times when you come out of the parking lot. And there's also the airbag. The seatbelt is very much like your disability insurance. It's universal coverage at any time, anywhere, whatever may happen. There's no limitation on when it's active or not. It is always there. Whereas the airbag is only deployed in very specific situations, like your critical illness plan covers very specific conditions, a heart attack, stroke, cancer, and so on. It is not a universal plan. It is specific to usually 25 covered conditions. And it's really intended to deploy, just like an airbag, under very severe moments. Severe accidents would trigger an airbag. Similarly, it's not the cancer that's a minor little spot on your skin that the doctor removes at the clinic. It's a life-threatening cancer that is the trigger for that benefit. So, if you will, the things that keep you safe in a car, seatbelt and an airbag work in concert. In similar fashion, in the living benefits camp, you've got disability insurance and critical illness.
So how does disability insurance and critical illness coverage work? Should people have one over the other?
Yeah, I guess I kind of jumped ahead of myself there, but yeah, absolutely. I think that if you have income to protect. You should have disability insurance. So as soon as you're earning an income and during your earning years, you should protect that ability to earn. That's your greatest asset, quite frankly. And critical illness insurance should be in tandem. I don't think one is, replaces the other. There are two different needs and two different circumstances. And even though the same event may cause both policies to pay out, take cancer, for example, you may be off for 12 months trying to recover from a situation, but the sudden impact of such news and the ensuing recovery period may dictate that you have extra costs, and a critical illness contract paying a lump sum in addition to your cash flow being covered by your disability plan work in concert to give you the freedom to focus on recovery rather than worry about the mortgage or any other financial stress at the moment.
Excellent. Thank you. Yeah. I'm always intrigued. I had this question running through my mind as we approach this. Why are people so diligent to insure their home, their car, spending thousands of dollars per year, and yet neglecting to insure the person who pays for all these things themselves? What's behind that?
Jim, actually, that baffles me too, quite frankly. I'm, people very comfortably pay, $2,000-$3,000 to insure their home and another couple of grand to insure their car or various cars. They're spending thousands per year on things and not spending the money to protect the very person themselves that provide all those things and pay for all those things. Let me give you another analogy. I'm an analogy guy, so forgive me. I don't know if you've ever heard the money machine discussion, but just imagine for a moment there that the government of Canada permitted you to have a money machine, a money printing machine in your basement. And they said, Jim, you're allowed to produce $150,000 of crisp $100 bills each year. And the only thing that we ask is that you limit it to that 150,000. We'll let you know when you can increase that. We'll allow you to increase it maybe by 2 or 3% each year, but basically that's what you're permitted. But the deal is that you have to give us about 30 to 35% of that each year. Okay, so that's the deal. You go, sounds like a good plan to me. I wouldn't mind one of those machines in my basement. So now you think, oh, well, I've got my home insurance renewing. I've got my Persian rug covered, my jewelry that my wife has stashed away in the freezer covered in addition to my home insurance. Maybe I should include this money printing machine. Wouldn't you consider insuring that machine?
Absolutely. Yeah.
And how would you value that? Would you value it at 1 year's production of cash, 2, 3, 10, 20? Like, how do you figure out the value that you should insure that for? You don't have to answer that. But the point is, we would all evaluate the longevity of this machine and say, you know what, I need to protect it for more than just 1 year. And we would certainly pay 1,000 or 2 or 3 to protect ourselves against the loss of that cash flow. Well, you know what? We are that cash machine. We are that machine, but we're skin and bone. We are not metal and nuts and bolts protected in the basement. We go out in cars. We walk across streets. We do crazy activities sometimes, hang off, climbing walls and things like that, and we take risks. And the reality is that we are far more valuable than that machine because it's not just dollars and cents, obviously, but we certainly should be looking at protecting our income, and not just 1 year of income, but multiple years of income. So that's really the essence of your question was, let's go back to that. Why is it that people are so apt to insure their homes and cars and not themselves? Like I said, I'm baffled. And when you think of it this way, perhaps some of our listeners might think a bit differently and perhaps be persuaded to say, you know what, I need to take care of this if they haven't already.
if they haven't already. Yeah. And just another question around the sobering aspect of disability. What is the likelihood of disability before the age of 65? How long is the average duration to recovery? I mean,
Mhm.
we're
Yeah.
not machines
Mhm.
where parts can be replaced.
Yeah, that clearly, there's hospitals full of people that are dealing with something, whether it was an accident or an illness or some combination. So this stuff happens. The question is, how often does it happen, and how long does it last? And
Mhm.
and statistics are interesting, but generally, if you look at, depending on age, obviously, but generally, if you look at a group of people, roughly 1 in 3 will suffer a disability lasting at least 6 months between now and age 65. So if you have three buddies, chances are one of you are going to be it. Now, take this a step further and think about if you're in a partnership relationship, you and your partner are two people. The chances of one of you becoming disabled or critically ill, so one of these four things to occur, either disability of each other or critical illness of one or the other, is somewhere between 50 to 60% possibility. Whereas the chances of either one of you dying before 65 is minuscule compared to that.
Yeah.
We're probably 20 times as likely to have a health event by 65 than we are to die. The good news is that we're going to be around, okay? But the bad news is that some of us are going to have a bump on the road that's going to disturb our cash flow, and it's going to require us to draw on our reserves quicker than we anticipated, not leaving it to retirement. And that's not a good thing from a financial planning standpoint.
That's right. That's right. Yeah. Interesting. What happens to the income and expenses when someone is disabled or suffers a critical event? It's not
Mhm.
like Bill's hydro stops. Uh,
Yeah, not only do the bills continue, but I would suggest to you, if you think about this rationally, depending on the nature of your recovery or the illness itself, there may be additional equipment, there may be additional services or care required for a period of time or ongoing potentially too, depending on the nature of it. And even if you recover a year or 2 years later, during that period of getting better, there's interruptions and there's additional costs. Even going to the hospital and paying for parking, I find very expensive. That is not covered by your OHIP plan. And as you know, we all have experienced the push down of ancillary healthcare costs to us individually, even though we've got a very robust and good healthcare system. Envy of the world, quite frankly. People look to Canada and see our system. No matter how many of us may poke holes at it, it's still a very robust and attractive program. But there's a lot of things that we are now starting to pay for in order to have good care.
and what is considered total disability? What if I feel better, but I'm not
Mhm.
fully recovered?
Yeah. Well, let's talk about the definition of disability because that's important when it comes to these contracts. And I guess this is a good spot to kind of lay the land of what's out there. I always like to talk about group insurance because that's the most common starting point that most people have experience with or know about. So any group plan that I've looked at, with one exception in all my 3 decades of experience, will have what is called a regular occupation definition for the first 24 months. What that means is that if you can't do what you do today due to accident or sickness, then you are considered totally disabled. After 24 months, it becomes what's called an any occupation definition, which says that if you can't do anything for which you're suited based on education, training, and experience, so that's a much wider net. And so now, maybe I used to flip hamburgers at McDonald's, which I used to, by the way. Does that mean that I'm no longer considered totally disabled because I can't, you know, creatively think about solutions for my insurance clients? Possibly. So your group insurance may stop covering you after 24 months if you're not fitting that definition of any occupation or falling into the any occupation, if you will. Now that's group insurance. In the realm of private coverage, you have the ability, most classifications of individuals, depending on the type of work you do, will qualify for a plan that allows you to have a regular occupation definition all the way to age 65. So there's no point at which in the future suddenly your benefit stops. And by the way, as evidence of this fact, I always reference the advertising you hear on radio. 680 News, if you will, for example, will have various lawyers come on and say, if your insurance company is not paying, call us, we'll help you, we'll sue them, and we'll get you your money if they're not paying you on your disability claim. Well, that's typically because you have a group plan that has expired the 24-month period, and they are no longer paying you benefits. And now you're required to, suit up and see if you can get your money. That is typically not for private contracts.
Okay, so there's reading the fine print is really
Yeah.
important.
There was
Flipping
a
over
second. There was a second part to your question. Let me just go to that because you said, what if I'm feeling better, but
yeah,
I'm
not
still not fully recovered?
right.
So we're talking about sort of the gray period of transitioning from totally disabled to totally healthy. Like we're not robots. We don't, they don't flip a switch and suddenly we're all back together and we go. There's a period of gradual recovery. Maybe the doctor says go back half days, or you can do certain duties but not all your duties. And eventually we take on more and more and are hopefully able to get back to full time and full capacity. So what happens during that gray period is the question. And that's where, again, a good quality contract will have partial disability or residual disability definitions that accounts for how do we continue to make payments to this insured individual on a partial basis, on a proportional basis, as they work towards recovery. The insurer wants to get this individual back to work, but they don't want to rush them either, because the last thing you want to do is a relapse and a longer recovery.
Right. Okay. Okay. Um, when it comes to the critical illness insurance policies,
Mm-hmm.
what are the covered conditions? Are there some top conditions?
Mm-hmm.
I realize that when you read some of
Sure.
these policies, they talk about 27 possible illnesses that one can face.
Mm-hmm.
What are the top
Yeah,
ones?
absolutely. So, as I mentioned earlier, it is limited. So you're absolutely right. There's a specific list, and typically it's somewhere between 25 and, as you pointed out, some may have upwards of 27 covered conditions. The reality, though, is that the top three account for about 70% of all the claims, which are heart attack, stroke, and cancer. And cancer by far is the lion's share of that. Roughly 60% of all claims come from cancer-related claims. Now, there are many other covered conditions. One of the ones I like on the longer duration critical illness contracts, and one you should look for, really deals with long-term care concerns. So it actually lists Alzheimer's and dementia, and it also lists the two activities of daily living out of the six typical that we are so accustomed to assume that we can all do, like feeding yourself, clothing yourself, bathing yourself, going to the washroom on your own, and so on. So if you're unable to do two of those six daily activities of living, it triggers the benefit. Each insurer, of course, has their own way in which they handle that, whether they pay out the lump sum or they pay out a monthly benefit. There are variations, but the idea of having a critical illness contract that not only protects me against the heart attack, but also against the potential of the longer end of my lifespan, and saying, what if I decline in health and need protection or care when I'm 75 or 80? There is a solution there in those products as well.
So a thought that usually I encounter or discussion, if you will, with various clients is coming up with the answer as to who should be ideally looking for coverage at what stage of your life, at what age? Is there any experience in your travels that you could relate
Sure.
as the best timing for this product, these products?
Yeah, let's look at them separately for a moment, even though I do pair them up often. In this frame of questioning, I would say that disability insurance, clearly because it's income based, you have to have at least 12 months of income history for an insurer to insure you. But as soon as you have that history, so the moment you are 24, 25, and you've got your first year of income, I would say you're protected. You may or may not have group insurance, depends on the circumstances. But if there's any gap there, I would at the earliest opportunity get some disability insurance, even if it's a token contract. When I say a token contract, it could be $200 a monthly benefit only. So you're not buying it for the benefit, but you can buy it with a rider that allows you to add coverage to it as your need increases, as your income increases. So you bank and you guarantee that in the future, despite change in your health, the insurer cannot say no to you. They will allow you to buy more coverage, and that way you've secured your ability to protect your income even in the future. So I would, the earlier the better when it comes to disability insurance. And at some point it becomes obsolete, quite frankly. I mean, if you're 64, planning on retiring at 65, I wouldn't bother with a disability contract. I mean, the claim time is so limited. There's not a lot of need. And if they've been talking to you and investing properly already, they're probably ready to retire and don't need any additional financial help anyway.
Good point.
But the critical illness side, I would say, is a different story. I would insure even the 1-year-old with critical illness coverage, because what you're doing is you're building this protection throughout their life, and you're picking it up at the earliest possible time when it's the lowest premium. You have the ability potentially as a parent to fund that over the next 15 years and have it all set up and done with by the time they can even think about what critical illness is. And you've given them a head start on that risk protection. The concern there is, aside from the actual product and price, is the ability to buy it. The risk is not just the health of the individual, but the health of the parents. So when you're filling in an application for critical illness insurance, the history of your family's health is really relevant, because if your brother and your father both had heart attacks by 45, you may have an exclusion on heart attack in your critical illness contract, even if you're an athlete and a marathon runner. So the earlier you can lock in that insurability, whether your health is at risk or your parents' health is at risk, before any of that shows up, you'll lock in that coverage.
Yeah, good point. Yes, the younger you are, yes, the more feasible it works out. How do you determine the right amount of coverage? Is there a formula? Is there a
Yeah.
spreadsheet? Yeah.
Yeah, I think there's some logic to this. Again, I'll separate the two because they're quite different in that regard as well. It's hard to tell how much critical illness insurance you will need if you do have a claim, because clearly, an MS claim versus a heart attack claim are going to be very different in terms of the length of time you'll need financial help on a critical illness plan I'm talking about. So it's hard to tell. But the rule of thumb that I use, or the general principle that I use, is basically anywhere between 6 to 12 months of your current income would be a suitable amount to protect yourself with critical illness. I want to buy enough time for my client to not worry about financial issues for that most critical period of recovery. I mean, if it lasts longer than a year, unfortunately, they may start to have to dip into other resources, but at least it's not an immediate shock. Remember, it's the airbag. It's taking, an airbag is not going to prevent you from getting bruised and hurt and so on, but it's going to minimize the impact of an accident. And that's the premise of a critical illness contract too, we were trying to minimize the financial shock to the family in the event of a major health crisis. And if we can do that for 12 months, that's fantastic. On the disability front, though, it's really governed by a percentage of your income. I mean, there's only so much you can buy, and it's governed by what the insurer will permit you to buy. So I always run it at the maximum that they'll allow, and it's typically somewhere around 2/3 of your income. Now, keep in mind it's paid as tax-free income, so it may very well be very similar to what your take-home pay is, but that's typically the starting point is about 2/3 of your income. And as your income increases, the proportion or the ratio of protection that you can buy actually reduces. So if you're, if you're earning $1 million a year, you cannot buy $666,000 of disability insurance. It caps out at about 350,000.
Okay, so each situation clearly has to be analyzed carefully in terms of the occupation and what each person encounters as their cost of living.
Yeah. Actually, you mentioned occupation. If I can just jump on that for a minute, that is a very important criteria when it comes to disability insurance. For critical illness insurance, it doesn't matter what you do professionally, but for disability insurance, it's very relevant. So just think about and I'm not taking any knocks at any particular profession, but take a blue collar individual working with their hands, physical labor of some sort versus a physician. The risks associated with being a doctor versus hurting yourself on site at a construction site are very, very different. And therefore, the classification of occupation comes into play. So that's what insurers do, is they classify them based on the kind of work that you do, and what that classification ultimately reflects on is the risk and the premium. So the premium for a doctor for the same $1,000 of protection is clearly cheaper or lower than it is for someone working on a construction site.
The hazards of the job.
Yeah.
A common question that I come across is employees who already have an existing plan and will tell me that they have a short-term disability plan in place or a long-term disability plan in place. What should someone who has a plan be conscientious of through their employer and what it means to their future?
Yeah, it's interesting. Just about, well, I would say everyone that I've ever asked, what is your benefit? They may have an answer, but they're usually humming and hawing and guessing and not sure and saying, I have to look it up. I mean, this is not the kind of stuff that people pay attention to often. They sign a form when they join a company and away they go. And rarely do they really think about their short-term or long-term disability insurance until they're at the hospital and having to claim. And it's at that moment they realize, oh, I better look up what I'm actually going to get in terms of cash flow. Is it going to pay my mortgage or not? So an exercise I always do is ask clients for their benefit booklet. And I pin down exactly what the contract or the benefit booklet says as far as what their coverage is. And invariably, it is less than what they thought. And I'll tell you, there's a couple of reasons for that. One is people don't understand that often group plans only insure your base income, not necessarily your overtime, not necessarily your bonuses or your other types of remuneration that may be on top of that. Second thing is that often people have defaulted to the non-evidence limit. That non-evidence limit terminology just means that without medical evidence, the insurer will give you, let's say, $3,000 of coverage, even though the group plan may have an upper maximum of $10,000 monthly coverage based on your income. Unless if you do a medical form and get approved for it, you've defaulted to the non-evidence limit of $3,000. And most people don't pay attention to that when they sign up to a new employer. It's the last thing on their mind. They're dealing with who's going to be my boss and what am I going to do tomorrow and what did I sign up for? Their group benefits is the last thing on their mind at that moment. So, a a review of your group benefits with a professional clearly is a good starting point. At least know what it is you do have. And that way you can determine, is there a gap? Are you comfortable with the amount or not? And then take action accordingly.
What are the features people should look for in a quality disability policy? Throughout this conversation, you've been hinting.
Mhm.
Could you be a little bit more
Yeah,
concrete at this junction, maybe recapping?
sure. Without making you all professional insurance people here, because we can open up the hood and pick apart lots of things. But let me list a few that are really, really important. And the most important, first and foremost, is the definition we talked about earlier. So, it's your regular occupation, not an any occupation contract. It protects your ability to do what you do. That's first and foremost, and it's probably, half of the way there. Once you've got that kind of contract, you're probably dealing with a fairly decent plan to begin with. But I would say partial or residual disability needs to be in there. So remember that gray period needs to be covered. Limited exclusions. What are the exclusions in that contract? A good contract will only have things like, if you get incarcerated or, acts of war or something of that nature, but nothing beyond that. Coverage should go to age 65, not a shorter term period, like 5-year benefit. What if you've got a permanent disability? You want this coverage to continue. And ideally level premiums. It's not a deal breaker, but I would say, generally you want to lock in that premium so that you're not dealing with higher and higher premiums as you age.
Right. And if your salary doesn't keep up, boy,
Mhm.
can that add up? Sure. Okay. Are there any extra riders that you have found people overlook, and which ones would you recommend and why?
Sure. Yeah, absolutely. I would say for those who are 45 to 50 or younger, there's two features that I always include, or at least recommend. Whether the client proceeds with it or not is their choice, of course. We call it COLA and FIO, so cost of living adjustment, so some sort of indexing feature. And the other one is future insurability option. The COLA basically indexes your benefit upon disability. So if you've bought a $5,000 monthly benefit, you become disabled 5 years later, it still starts at 5,000, but from that point forward, for as long as you're disabled, it creeps up in terms of benefit year on year. So if it's a long-term, you get disabled at 35 and you're disabled till 65, that's a 30-year window period. You want that $5,000 to keep its value. The future insurability option, I think I alluded to earlier as well, is the idea of being able to buy more coverage in the future based on your health today. So you basically pay a small incremental premium based on your good health today. And because you've done that, you've banked an additional few $1,000s of monthly protection that you can add to your current coverage as your income increases. So for example, you start with $5,000 of benefit again, and next year your income is increased. You show your T-slip to the insurer. That's all you evidence is the fact that you've earned more income, and on that basis, they increase your benefit to 5,500, and so on. Of course, you pay a premium for that additional amount you bought, but you're guaranteed to be able to get that. Those are the only two I would add.
As riders? Okay.
Yeah.
And when does it make sense to do return of premium? Is it an
Ah,
age related? Is it
yeah.
uh,
Actually,
I mean,
good question. So yeah, return to premium, first of all, the idea that you would get a refund of some sort on your premiums if you don't have a claim. That exists
right.
on both the disability contracts and on critical illness contracts. The critical illness contracts, well, let's answer the question. The question is, when do you add that? And I would say that I would do that only when I have a client who has surplus cash, non-registered money sitting in GIC type investments, earning highly taxable interest income. These are excellent alternatives to that kind of investment because the internal rate of return, if you measure it mathematically, of paying that extra premium to get a refund on your overall premium on your disability or critical illness contract is a fairly high rate. It's somewhere in the 10% range. So if you're putting money away in a 4% GIC and paying half of that to the tax department, you may be better off putting that excess in your return of premium. But most clients we're dealing with in the income earning years don't have that kind of surplus sitting around. So I'm very cognizant of, I don't want to oversell that feature if it's not suitable, obviously.
And you, we touched on jobs and how people transform their careers, and you yourself have described some summer jobs that then led to different choices. What happens when a person changes jobs and the plan that they had is either not accompanying them?
Mm-hmm.
What's the vulnerability? What should they be thinking about during their working years so that problems
Yeah.
don't arise?
Yeah. Well, I mean, the reality is that we don't stay with our employers for 40 years anymore. We do move around somewhat. So the portability of coverage is an important aspect. Now that doesn't exist with group insurance. So first and foremost, you must realize that if you're relying 100% on your group long-term disability plan as your safety net, the moment you leave that firm, it's gone. Your new firm may or may not have it. They may have a 3-month or 6-month probationary period before you qualify. You may be in between jobs for 3 months looking for the next gig, and in that time become disabled. What happens in that case? These are risks. So the ability to have a private plan that migrates and ports with you is an important aspect of private disability insurance coverage and should not be overlooked. Even if it's that token policy I described earlier, those token policies may permit you to immediately accelerate the future insurability option we talked about and begin to up that amount fairly rapidly based on your prior income. Aside from that, you may also change your career itself. You go from being a doctor to opening up a restaurant. We have a colleague here who used to be a dentist. He's now a financial planner and an investment advisor. So people make all sorts of interesting changes in their careers that they never planned on when they were in university for 4 or 5 years getting there, right? And if you're relying only on your association plan with the medical association or the dental association, and you're no longer practicing, you're no longer part of that association, your coverage no longer covers you. So the ability for you to have a private plan that continues to cover you, even if you make a change in your classification that we talked about earlier. You've gone from a doctor to a restaurateur. Do you think that's an upward or a downward risk classification? What do you think, Jim?
Well, I would say you're increasing your risk.
Correct. Correct.
Yeah,
Yeah,
sure.
absolutely. I mean, a restaurateur around knives and forks and hot elements and moving around, and even the ability to be on your feet for long periods of time is very different than a doctor that perhaps. Yeah.
Mm-hmm.
So, but the interesting thing is, if you've already got a plan that is a doctor classification, you get to keep that classification. The caveat here is, of course, I'm talking about the better products that I would normally recommend for a physician. That would migrate with that individual. It would remain at the same premium, at the same classification, even though they've made a major change in their risk.
So things to keep in mind when you're changing jobs, yeah, and layoffs. Throw in layoffs. Throw in the unexpected things that you can't control. Would coverage continue when laid off from work?
Yeah, that's
in light of what I did.
Yeah, exactly. So as I mentioned, your group plan will not, but your private plan would, and the nature of your the test of the definition of disability is your regular occupation. Well, your regular occupation has gone from maybe managing administrator in an office to finding a new job. Your new job is to find a new job. So the test that the insurer will use if you have a claim during the period that you're actually looking for a new job is, are you able to do the things that are required, like preparing a resume, making phone calls, going to interviews? These are the things you would normally do in the process of trying to get a new job. And if you're unable to do those regular duties, then you are totally disabled. That's the test. So it actually literally migrates with you where you are at the point at which you need it.
And with the return to work, so you're getting better. You mentioned this earlier, you're getting better, you're not quite there. And then as time goes on, your mobility or your mental capability just doesn't allow you to go back to full-time work.
Yeah.
What does
Yeah,
life
absolutely.
look like for that person?
Yeah. I mean, the most productive individuals want to get better. They want to get back to work. They want to see their colleagues, maybe not 5 days a week anymore, as you know. But nonetheless, we want that mental stimulation and interaction with our clients and customers and colleagues. But if physically they're unable, or the doctor has recommended that they not, even though they feel like they can, gradual return is important, and nobody should be rushed to do that. Certainly not because of financial reasons. And that's the very reason why I recommended that, any good contract have some feature that deals with partial or residual disability, so that it actually allows them additional income, a proportional income during that period of recovery.
Okay, so really important to look at what terms and conditions you've signed up for when it's a group plan.
Mm-hmm.
And obviously, when you're dealing with a professional like yourself, that will be the center of the discussion. So, Greg, what are the most important things that we have covered here that you would like our listeners to walk away with?
Jim, we've covered so much. I really do want to make this actionable for people. So I would suggest that there's a couple of things. First, just have a look at your group plan, review it, maybe have a professional look at it. And that's really the second part of my recommendation, is to really involve a professional, because chances are, even if you review it yourself, you may misunderstand or misinterpret the documentation you're looking at. So work with a professional insurance expert that will evaluate what you have, identify any gaps, and make recommendations to you of your options. Not forcing you to make any decisions, but to allow you to make intelligent decisions that are informed.
With that, I would like to thank Greg for his time and wisdom as he covered some of the most important points when it comes to living benefits. And we've just, covered a lot of the highlights of both critical illness and disability insurance. I'd like to remind you that it's important to thoroughly review and understand the terms and conditions of any living benefit insurance policy you've signed before making any decisions, and including adding more coverage or looking for more unique features. Raymond James has more than a dozen insurance providers to select from with the help of an advisor. This means our clients' requested needs can be matched up with the right insurance provider's risk coverage. An important part of working with Raymond James is there's always a buffet of choices. And as always, the team at Bose Wealth Management look forward to working with you and guiding you through this complicated discussion. Feel free to reach out to me by calling me at 416-581-0081, extension 209, and ask for Jim Voudouris. Thank you for taking the time to listen in our Living Benefits podcast.